interest that is charged on for 10 days, right? So this is called note receivable. This is also a one kind of like, you know, if a company is giving some time to the customers to pay them back money, so it means company is losing some money during this time. So if the arrangement is like that, because this is a part of business, but if a customer is not paying for, normally 30 days credit is a normal limit for overall the world, because big businesses, money is coming in, coming out, so lag time is around about for some 10 days, for some 15 days, but back to maximum 30 days. But if a customer requires more than 30 days, then the company say that since you are our prime customer, we don't want to lose you, but you are demanding extra time. So in that case, we would be charging you some extra amount, as it's like we are giving you a loan after 30 days, right? So in that case, you sign a note, right guys? Any question? Ali, Kathleen, Coco?
Sir,
Yes,
sir, sorry, I have a question. It's also related to the assignment. You give like each transaction. Some transactions, sometimes they can go to the cash and to account receivable, or either to not receivable or to account payable. Sometimes. So how can you exactly know, unless because sometimes you write it down like cash received on account, so now I know it's account receivable or account payable, but sometimes like it's kind of tricky. How can you really distinguish? Is the amount of the transaction which will distinguish if it's cash or?
No. The question itself mentions specifically that it is a cash or not. Okay, so don't worry about right now. We will be having our illustration. We will be doing that one, and we also have a breakout room activity as well today. So don't worry about that, how we are going to segregate the account. I will show you in example. Just go through this. I would say that the dry part, which is the definition, so just try to digest, and when we go to the illustration, then we really understand what's going on. Just wait for a second. Okay, any other question? Okay.
I have a question, sorry.
Yes, sure.
When for the second assignment, when you just put things in parentheses, does that mean it's a negative number?
Yes.
But okay.
In accounting, so we don't use the word minus. We use parentheses. Parentheses
Okay.
minus. But you can use that. I have no objection for that. If you want to use that one, okay, use that one. But the standard convention is that use negative as in parentheses. Okay, the other account for asset categories, they are inventory. What is inventory? Inventory means that goods the company sells to the customers. So your raw material, right, is your inventory. You convert the raw material into finished goods. You didn't sell it yet, so those items that are in your stock, that is your inventory. So when you sell the inventory, that becomes the sales. Okay, before sales, that is your inventory, because it's still in your company's go down stocks or whatsoever, right? And also the prepaid expenses are your asset. Prepaid means that you paid in advance, right? For example, insurance and rent. We also talked about in our previous lecture what is prepaid. So the name implies prepaid, already paid in advance. So for example, the services of like whitewash, cleaning, insurance, rent, you paid in advance. So expense didn't occur yet, but you paid in advance. So you didn't receive the benefit. Benefit will be received in future, right? So if something happened for insurance, so it is depending on future. For rent, it depends on future use. You will be using 30 days and then rent expires, right? So until it is not, expired, that is your asset, right? Insurance for 30 days. After 30 days, that becomes your expense. But right now, you paid in advance, that is your asset because it has future benefit. The land. So the cost of land used in operations, that is your asset, of course. If you buy a land for business purposes, it will definitely will be providing some future benefit. Whether you invested or whether you use that for operations, if you invested, you would be selling out after 1 year, 2 year, 3 year, whatsoever. It will give you future benefits. Similarly, building, cost of buildings, these are uh, also future benefits because you are using them in operations, right? Equipment, furniture and fixtures, computers, right? Chairs, this kind of stuff, ACs, the water coolers, air purifier, this kind of stuff. But remember, it comes with another account, that is depreciation account. So why this is unique to these assets? Because assets are subject to have a wear and tear after some usage. So if you use the equipments, furniture, fixtures, even the building, you use that one, so it has some wear and tear. So that is the reduction in cost, but that doesn't mean that you are, you know, physically paying that one. So depreciation is basically non-cash, right? It's a non-cash item because it doesn't involve hard cash. So wear and tear doesn't mean that the in dollars you pay or money is going out from the business, right? Neither it's a reserve account that you save some money and you put it into depreciation account. When the asset expires, you purchase a new one. No, it is just, you can say, a figure that has no physical balance, but yet law allows us. Why? Because you know that if I purchase, even if I purchase the phone for like 2 days or 3 days, when I want to sell it, it will be sold at reduced value. Why? Because 2 days you have used that one, right? So when you sell it, then the reduction in value becomes some kind of like actual thing. But you didn't sell it, you're using that one, but it is just, you want to know that how much I use that one. So that's why we call it's a non-cash expense, right guys? Now regarding the liability side, which is the right hand side of the equation, assets is equal to liabilities plus owner's equity. So what is a liability? It's a debt or outsider's claim, and the accounts are account payable, which is that promise to pay a debt. Normally it occurs payment to supplier. Like account receivable is specifically to the sale of goods. Similarly, the accounts payable is for suppliers, right? You purchase raw material, you purchase goods from your suppliers, and you sell it to the customers. So you didn't pay them yet. You said that, okay, I would be paying you after 30 days. So 30 days, it means on your business, 30 days, there is a claim that is outside the claim, that is a debt, and that is on burden on the on your business, that is a liability, right? Outside this claim. Notes payable also in the form of that you make on company's letter a note that, okay, I will pay you after 30 days, but the money is stuck with me for 30 days. I would be paying you, for example, 2% interest for the money I owed. So you just sign it here like that. On specific date is mentioned here. Company logo is there, right? And you undertake like, okay, you would be paying. So normally the notes receivable is not for like some infamous customer. So it is trusted partner or some big companies who have a history of performance and reputable businesses, so they write this kind of stuff. Accrued liabilities, like we talk about prepaid expenses, right? So accrued liabilities are the opposite of prepaid expenses. It is that expense occurred but not paid, right? For example, salaries, the employees worked for you for the whole month, you didn't pay yet, so it means it is payable, right? So it is called accrued liabilities. You gave a contract to whitewash your office building, and you said that, okay, I will be paying you after 15 days when contract is fulfilled. So 15 days they whitewash your building, and after 15 days now the expense is basically is going to be paid. But before 15 days, at day 10, day 12, even if they finished all the building whitewash in 12 days, still they won't get. Why? Because you have the option to pay them on 15th day of the contract. So before that one, it is payable. Salaries are payable, right? So accrued liabilities, it means expense occurred but not paid. This kind of stuff we record is as liability because this is a kind of outsider claim or a debt, right? But why we can't call it debt? Because that related to some payments of expenses, right? We are not using the money. Basically, we are holding the money and we will pay them back, right, guys? And now the owner's equity accounts. Number one, owner's equity, which means insider's claim, right? Or owner's claim on the business. Number one, common stock. Common stock is basically, it is owner's investments in the form of stock. Retained earnings, I told you, it is all the previous earned incomes that you didn't distribute, you retain in the business, which we can calculate through formula. Net income, minus dividend is equal to the retained earning, or beginning retained earning plus net income minus dividend is equal to ending retained earnings. So dividends, they are distribution to the stockholders. They reduces the owner's claim. Why? Because from business, payments is done to the owners, so that's why cash decrease and their basically contribution also, or retained earning also decreased. So dividend decreases the retained earning, and when retained earning is decreased, ultimately owner's equity or stockholders equity also decreases. How dividends are paid, so that is not the point of right now, but just this one, that it is declared by board of directors. That's it. In annual general meeting, they vote for that. Okay, today we are talking about distribution, whether 5%